Welcome back to Your Money Matters. I'm Angela Giroux, publisher of the Bauman Letter, and joining me today are Ted Bauman and Clint Lee. As a reminder, before we get started, the link to find out more about the Bauman Letter can be found below, and you can subscribe risk-free. But of course, the big news today and this week is what's going on in the markets, because it has not been pretty. Big tech, specifically the Nasdaq, we're in correction territory. And I'm sure it's leaving many investors rattled. These are investors who thought these stocks in particular, could not go down. So I'm sure they're wondering what to do. So Ted, what do we do?
Well, I'm looking over my shoulder at the Nasdaq. It's down almost a point today. Apple over 2% down. Google and others, and point and a half, whatever. I mean, basically, it's another bad day. So this is not letting up. And I think, one of the things here is that there are so many people who have heard about what's going on in the market. They want to get into the market. They want to start trading. The other day, the builder who's actually working on rebuilding my garage said, "Hey, I just bought Apple at 119. Do you think I did the right thing?" And, I tried to be positive, but I was like, honestly, when I look at Apple's price chart and I look at its price to earnings ratio, and explain all those things to him, I said, I just don't think it makes any sense. I said, don't sell them. Someday you'll make some money, but it might not be soon. So really what's been going on, let's look at a couple of charts. One is, first chart shows you the put call ratio. Basically, it's the ratio between the total volume of put options, which are options betting against stocks, and call options, which are betting in favor of them. And what we've been seeing is just a dramatic fall, which means that a lot of bullishness in the options market. People have been buying more and more calls, which is really a cheap way to try to gamble on the rise of stocks without having to pay for the whole stock. Next chart shows the volatility that we've seen in the last couple of days. And as you can see, it's all clustered around the top: Tesla, Facebook, Google, Amazon, Microsoft, Apple, Nvidia, Netflix, Adobe, PayPal, you name it. All the big guys in tech have been the most volatile. And then on the right-hand side of that chart, you can see that really this has been a phenomenon that really picked up in July. We started to see ramping up of call options being bought. And that's a very significant trend line there. So fundamentally, I think what we're seeing is that we reached irrational exuberance, I guess you could say. We reached the exuberance phase of a bull market, and what normally happened. The people, smart money, decided to pull out, and now it's cascading out. We're getting some profit taking, or rather value buying. They think it's value buying in the mornings, and then by the evening, things are starting to look down again. So this is a time, I think, when people who've just got into the stock market want to know, how do I pick the winners here? What do I do? And I think that's the critical issue. But we've got some suggestions.
Right. Well, especially with this volatility, it's no longer, like you said, which stocks to buy, but when to buy them. And Clint, I know you've definitely got some expertise there.
Yeah, you say that like it's an easy task to figure out when to buy them.
Isn't it?
In your sleep.
No, it's not. But there's a lot of tools at our disposal that can at least help assist with that decision. And yeah, that's when we really turn to technical analysis. Using fundamental analysis can help us determine what looks attractive to buy, and then the technical analysis can really help us pinpoint when's the best moment to go in or to sell a position that you already have. Now, within technical analysis, I mean, there's probably hundreds of different indicators that are out there, but I like to keep it simple. And even just a simple moving average can tell you so much about a stock or an index and where it's at, and in terms of tracking sort of the herd mentality of, is there too much bullishness? Is there too much bearishness? You can gauge a lot from those things. And I'll give you an example to show you exactly what I'm talking about. So let's pull up a chart here of the Nasdaq index, and this will go back to sort of Ted's comment on reaching irrational exuberance that we've been seeing recently. So this is a daily chart. This goes back to the start of the year, and the orangish gold line is a 50-day moving average. The green line is a 200-day moving average. And then there's an indicator at the bottom panel. We'll come back to that one here in just a second. So just focus on what's happening with price. So with the Nasdaq, we hit that 12,000 level, and we've had a decent pullback here so far now. you might be seeing some technical analysts coming out and pointing out that we're now back to the 50-day moving average. And that's been, historically, that can be a good area of support. Some other things are starting to get oversold. But in my opinion, there's still just too much bullishness that's out there. And you can see that with the distance that there is between the price index and the Nasdaq and the 200-day moving average. I'm highlighting with the circle on here. Just visually, you can see how far above, how extended this trend in the Nasdaq still is. And what I like to do is to just quantify that relationship a little bit more. So what's the day-to-day, what's the distance of the Nasdaq price index relative to that 200-day moving average? What's the percent above or below where that's trading at? And that's the next chart here. So this takes that Nasdaq price index and plots how far above or below in percentage terms it is compared to the 200-day moving average. And there's several interesting things to point out here on this chart. If you can see the time scale on the bottom. If you look back to the start of this year, this index, the index was about 20% or so above its 200-day moving average. And that is an extended level. That's a level where you should not be putting new money to work. That shows there's too much greed, too much optimism out there, and that's a contrarian indicator. And we were due for a pullback. Now the pandemic helped make that pullback much more severe, and you can see how far that took us the other way. That took it all the way down to about 20% below that 200-day moving average, which coincidentally is about the same distance below that it was in the fourth quarter of 2018 during that sell-off. You can see that all the way on the left-hand side of this chart. So that that's indicating, once again, by tracking where things are at relative to moving averages, we can see how much fear, how much bullishness is out there. And to Ted's comment earlier, if you take it back to the right-hand side of this chart, you can see that even with the pullback that we've had, we are still just extended above that 200-day moving average. As you could see in the prior chart, we're still running at levels of where we were at the start of the year. And so, that's why I say, even though, we pulled back to the 50-day, there's some measures that just suggest that we're still too far extended above that moving average.
Clint, can I just stop you and ask a question? If I look at this chart, the one that you just showed, you can see that it looks like previously there's been, I don't know if you want to call it a resistance line, but 10% seems to be about where the market is comfortable, somewhere between 0 and 10%. When we get up to near the 20%, it just makes you wonder, how are we going to fall back to that 10% of stocks above the 200, and what would that imply, for stocks?
Yeah, I mean, historically, when you take this even further back, what I've seen, to your point, usually you top out around that 10 to 20% range. That doesn't mean you have some catastrophic decline from there. It just means you've gone too far, too fast, and there's a consolidation. It could either be consolidation with declining prices. You could just see sideways, choppy trading action. But either way, it gets that 200-day back closer to the index. Now, where we were recently, just within the last week, getting closer to that 30% above, I think you have to go back to the tech bubble to find a similar situation. So even more extreme in this go around.
Mm. So fundamentally, this is not a good time to buy because there's just, you're buying at the highest price, and that's the opposite of what you want to do.
Right. And I'll give you, and I can give you an example with Apple. You're talking about Apple just a second ago. So we can use something similar to show an example of timing an entry into Apple's share price. So pull up a chart of Apple right here. This is the daily chart going back to the start of the year. We still have the 50 and 200-day moving average in this chart, but in the bottom panel now, we'll pay attention to this indicator. This is the MACD indicator. The indicator itself is the black line. And all that line is the distance between two moving averages. You got a short-term moving average and a long-term. So when the line's moving up, the shorter term's moving higher more quickly than the longer-term average, and vice versa when that line's going down. So once again, we're just kind of judging the distance between those two moving averages. Now, in terms of, back to Angela's question, it's how we time trades. In terms of timing a trade with Apple, what I'm showing with this black arrow right here, when Apple had a brief little dip and then made a move above 100, at the same time, you had that MACD indicator kind of resetting back near that 0 level, indicating those two moving averages were close to each other. And then you see the acceleration. And so that kind of confirmed the breakout in Apple that we saw. Now you look to the right-hand side and you look at, what's happening recently, you might think the same thing is setting up. Apple's pulling back to its 50-day. You've got this MACD indicators moving back toward that zero line. Or are we setting up for another breakout move higher? What I would say right now is probably not, because I think one of the mistakes that a lot of newer investors make is that they get so caught up in following what's happening on a day-to-day basis, or even starting to follow intraday charts, that you lose sight of the big picture. And this is what I mean by this. The next chart here is still Apple's stock price, but this is, instead of a daily chart, this is a weekly chart. So this is how Apple's moved on a week to week, but I still have that exact same MACD indicator in the bottom panel, and look at how extended these moving averages are on a weekly basis. So even though the daily looks like it's getting oversold, the weekly is way up there. And the last time this started to roll over, I'm showing with the arrow and the circle here, Apple had a 25% correction. So in terms of timing trades, this is just an example of using moving averages to see, to try to gauge whether we're extended in that trend, or if a new trend is just beginning to emerge, and how we can use those indicators to help pinpoint the right time with those opportunities.
Ted, I think you should send a link of this video to your contractor.
Yeah. Well, I don't want to disappoint him. I'll wait till he's finished. How's that?
There you go.
Yeah. I just, a couple of things just in response. Clint, I think, you're absolutely right. I mean, I think what a lot of people miss sometimes is even if they use these indicators, they don't use them on the right time frame. And so it doesn't actually show the long-term trend, which is what you want to be seeing. But in addition, I think, Apple is a company that sells mainly cell phones. It's trying to build a new business line in services and content. But right now, its price relative to its earnings is getting extended. And so that's another part of the picture. Anybody who's looking to buy Apple right now and is watching this price go down needs to then also start taking into account its future potential. On that score, I saw an analysis of Tesla the other day where somebody tried to extrapolate what the company would need to do in terms of earnings and profit margins in order to justify its current valuation. And essentially, over the next 10 to 20 years, the company would have to outperform every automobile, practically every manufacturing firm that has ever existed in terms of the rate of growth of sales and the rate of increase of its profit margins. It would need to be somewhere near 20% gross margin, whereas the norm in cars is around 7%. So in addition to the technical stuff, there's also just that reality, because when we play this technical stuff and this momentum game, we're really gambling. And this is what happens when you gamble. You get corrections because people realize, hey, this can't go on. It's like musical chairs, as we always say. So this is a musical chairs moment, folks.
Let's hope that this next week is a prettier one.
Well, there's a pretty good chance that it will be. I mean, I think my guess is that we're probably going to see some, a calm down in the markets, unless something crazy happens. Some more headline news that drives things down. Clint, what do you think?
Oh, yeah, I mean, one of the things I've been paying attention to recently is, this is a weak seasonal period, but then also, during an election year, September, October tend to be your worst months. But then, yeah, I mean, just the charts that we've shown, I mean, we've showed that even with the correction we've had so far, you're still extended. But as we talked about in prior videos, Ted, doesn't mean there aren't opportunities out there. You're pointing out earlier in this video the performance of Apple, Google, some of the other of the Fab Five, as you call them. But I was looking as well. I mean, Dow transports, a cyclical sector, we're up about 1%. Mm-hmm. And so just keeping an eye on it if we're seeing a rotation out of those high growth tech names into more value cyclical areas of the market. We've seen some evidence of that during these big down days.
Right, and that's something that we predicted a couple of weeks back on this channel. So good to be right for once.
Oh, you're right more than once. I think our model portfolio would prove that. Well, Clint, the exciting news is that Clint is actually going to be launching his own research service soon. So everyone will have a chance to tap into that expertise. We're really looking forward to that. And to make sure that you get updates on that, you could sign up for our free e-letter, Bauman Daily. There's also a link for that below. So make sure you do, because there is more to come from Clint, and I, for one, am looking forward to it.
Two.
Thank you, gentlemen.
Thank you, Angela. Take care, everyone.